Hey there, fellow investors and money-savvy friends. Today, we're talking about a strategy that's been endorsed by legendary investors like Warren Buffett and Jack Bogle, an approach that's helped countless ordinary people build substantial wealth over time. And the best part? It doesn't require you to be a Wall Street genius or have a trust fund to get started. Intrigued? Well, buckle up because we're about to dive deep into the world of low-cost ETFs, a game changer in the investing landscape that's been taking the financial world by storm. Whether you're a seasoned investor or just starting out, understanding the power of low-cost ETFs could be the key to unlocking your financial future. So what exactly are low-cost ETFs? Well, imagine being able to invest in a whole basket of stocks or bonds with just one simple purchase, and at a fraction of the cost of traditional mutual funds. That's the magic of exchange-traded funds, or ETFs for short. And when we talk about low-cost ETFs, we're referring to those with rock-bottom expense ratios that keep more of your hard-earned money working for you. Wait, what is an expense ratio, you might think? Let's break down the expense ratio in simple terms. An expense ratio is basically the annual fee that mutual funds and ETFs charge you for managing your money. It's like a tiny slice of your investment that goes towards covering the fund's operating costs. Now, you might be wondering, why should I care about expense ratio in low-cost ETFs? Well, my friend, the answer lies in the power of compound interest and the long-term impact of fees on your investment returns. Even a small difference in fees can add up to thousands of dollars over time. It's like choosing between a leaky bucket and a watertight one to collect rainwater. Every drop counts. Let's break it down with a real-world example. Imagine two investors, Alice and Bob, both starting with $10,000 and investing for 30 years. Alice chooses a low-cost ETF with an expense ratio of 0.1%, while Bob opts for an actively managed mutual fund with a 1% expense ratio. Assuming both investments grow at 7% annually before fees, Alice would end up with about $73,000, while Bob would have around $57,000. That's a difference of $16,000, all because of fees. But low-cost ETFs aren't just about saving money. They're also about simplicity and diversification. With a single purchase, you can own a slice of hundreds or even thousands of companies across different sectors and countries. It's like having a buffet of investments at your fingertips, without the hassle of picking individual stocks or bonds. Now, let's talk about some popular low-cost ETFs that have been making waves in the investment world. The Vanguard Total Stock Market ETF (VTI) is a fan favorite, offering exposure to the entire U.S. stock market for an incredibly low fee of just 0.03% per year. That's like paying just 30 cents for every $1,000 invested. Another crowd pleaser is the iShares Core S&P 500 ETF (IVV), which tracks the famous S&P 500 index and charges a mere 0.03% as well. For those looking to add some international flavor to their portfolio, the Vanguard XE Developed Markets ETF provides access to stocks from developed countries outside the U.S. at a low cost of 0.05%. And if you're feeling a bit more adventurous, the Schwab Emerging Markets Equity ETF offers exposure to emerging market stocks for just 0.11% annually. But here's the thing. Investing in low-cost ETFs isn't just about picking the cheapest option. It's about finding the right balance between cost, diversification, and your personal investment goals. Think of it like building your dream pizza. You want the right combination of toppings that suits your taste, not just the cheapest ingredients. One of the coolest things about low-cost ETFs is how they've democratized investing. Back in the day, you needed a fat wallet to get your hands on a diversified portfolio. Now, with just a few bucks and a smartphone, you can start building a globally diversified investment portfolio. It's like having a financial advisor in your pocket, minus the hefty fees. Speaking of fees, let's chat about why they matter so much. You see, when it comes to investing, you don't just earn returns on your initial investment. You earn returns on your returns and returns on those returns, and so on. This compounding effect is what Albert Einstein allegedly called the eighth wonder of the world. But high fees can eat into this compounding, like termites slowly but surely gnawing away at the foundation of a house. Now, I know what some of you might be thinking, but what about actively managed funds? Can't they beat the market and make up for their higher fees? Well, here's the kicker. Study after study has shown that the majority of actively managed funds underperform their benchmark indexes over the long term. It's like trying to beat traffic by taking shortcuts. Sometimes you might get lucky, but more often than not, you'll end up stuck in a jam. That's not to say that all active management is bad. There are certainly talented fund managers out there who can add value, but identifying them in advance is incredibly difficult, and past performance doesn't guarantee future results. With low-cost ETFs, you're essentially saying, if you can't beat them, join them, and there's a lot of wisdom in that approach. Let's talk about another advantage of low-cost ETFs: tax efficiency. Because ETFs typically have lower turnover than actively managed funds, they tend to generate fewer capital gains distributions. This means you have more control over when you realize gains and pay taxes. It's like having a tax-smart investment that works with you, not against you. Now, I want to be clear. Investing in low-cost ETFs isn't a get-rich-quick scheme. It's a slow and steady approach to building wealth over time. Think of it like planting a tree. You don't see results overnight, but with patience and consistent care, you can end up with a mighty oak that provides shade and shelter for years to come. So, how do you get started with low-cost ETFs? First, do your homework. Research different ETFs, understand their underlying holdings, and make sure they align with your investment goals and risk tolerance. Many online brokers offer commission-free trading on ETFs, making it easier than ever to start building your portfolio. Remember, investing is a personal journey, and what works for one person might not work for another. Low-cost ETFs can be a fantastic tool in your investment toolkit, but they're not the only tool. It's always a good idea to diversify your investments and consider seeking advice from a financial professional if you're unsure. As we wrap up this deep dive into low-cost ETFs, I hope you've gained some valuable insights into why they've become such a popular choice for investors. From their cost-effectiveness and simplicity to their diversification benefits and tax efficiency, low-cost ETFs offer a compelling package for both novice and experienced investors alike. If you found this video helpful, don't forget to smash that like button and hit subscribe for more investing tips and tricks. And hey, why not share this video with a friend who could use a financial boost? Remember, knowledge is power, especially when it comes to your money. Until next time, happy investing.